Well, the situation's relatively unchanged overall compared to 3 months ago. We're still seeing prices tracking higher at a more moderate pace. Turnover looks to maybe be softening a little bit, and everywhere we're seeing this tension between stretched affordability but very short supply. Probably the most striking aspect of the update this time around is the widening divergence that we're seeing in performances across different sub-markets. It's really quite a broad range now from hot, medium and quite cold, depending on where you are in Australia. In Perth, for example, conditions are still red hot. The market's tracking towards a 20% price rise this year, likely to be up 35% in the space of 2 years. That followed basically a decade prior to COVID, where prices were tracking sideways. And it's still against the backdrop of extremely tight supply, rental vacancy rates around 0.5%. Stock on market is equal to about 2 months of sales in terms of supply. More normally it's closer to 6 months. So no real signs that that's coming off, but prices are starting to get very stretched. The Perth median price surpassed Melbourne's median price for the first time since 2014, where the mining bust was starting to come through. And that's a pretty rare occurrence for Perth. But for now, it's really not showing much in the way of moderating. It's still going very strongly. It's a similar sort of story in Adelaide, but the cycle looks to be a little bit more advanced. Price growth has moderated a bit, down to around 15% on an annual basis, and there are some clearer signs that stretched pricing is starting to perhaps deter buyers, although price expectations kicked up over the last 3 months. So there's sort of a second wind coming into the market for now. Pricing-wise, it's looking very stretched. Adelaide median price, dwelling price, passed Melbourne's for the first time ever over the last couple of months. And whichever way you look at it, that makes prices look pretty stretched. Now, part of that story is about Melbourne. The Victorian market is really the softest that we're seeing nationally at the moment. Prices have slipped about 1% over the last year in the Melbourne market. The top end in particular is a little bit soft. And when we look at the market dynamics, there is an overhang of supply. So tax policy changes last year have precipitated an increase in listings, and that surge in listings is being very slowly absorbed. A bit of an overhang of stock at the moment. And looking forward, it's not a threatening situation at the moment, but it will take time to absorb that sell-off. And I think perhaps stable will be a good outcome for the market in Melbourne this year, and it may take the RBA to move into an easing cycle before things pick up. When we look at the eastern states, eastern coast states, again, it's a varied picture. In Brisbane, it's similar to the Adelaide and Perth story. Price growth is very strong, although there are some signs, like in Adelaide, that pricing's starting to get a little bit stretched, and there may be some slowing in momentum, and particularly around turnover at the moment, that's starting to come through. In Sydney, it's tracking at a much slower pace overall. It's in the 0 to 5% range for price growth, and turnover is quite soft in the Sydney market. So it's not quite the situation that we're seeing in Melbourne, but it's looking like it's tracking a more moderate profile. The other key feature here is that everywhere we look, there are these affordability issues. But in the markets where things are still going strongly, buyers are trading down into lower value parts of the market, in some cases seeing price rises at 30-35% over the last year. In markets where that affordability is already very stretched, so Sydney and Melbourne, that affordability picture looks to be pricing buyers out altogether. So they've much softer performance in terms of price growth. Looking ahead, the RBA is basically sidelined for the rest of this year, so we think that'll be the same situation we'll see through to year end, and then we'll get some interest rate easing into next year. But overall, we think that over the next 12 to 18 months, this performance will start to reconverge. In effect, those boom markets are really going to start to run into affordability constraints that see price growth moderate. And while some interest rate easing will give some support to the market more generally, it's likely to see price momentum slow in those markets, and a reconvergence in that performance back to a more uniform sort of 3 to 4% price performance in 2025. But right here, right now, it's a really wide diverging story. And even within each of these sub-markets, when we look at local areas within the capital cities and in regional areas, there's quite a variety of performances. And so I think at the moment, having an understanding of what these sub-markets are doing and why they're doing it is actually pretty important.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published, or reproduced in whole or in part without the prior written permission of Westpac.